Stop for a moment, because this is not a rally story. This is a credibility story. When government bonds, the quiet backbone of the financial system, begin to tremble, markets don't correct. They reprice, not slowly, not politely. One policy decision, one failed auction, one confidence fracture, and suddenly silver doesn't move in dollars. It moves in regimes. The question isn't if something breaks. The question is what breaks first and who sees it coming. Welcome to Boring Currency Reports. If you've lived long enough to know that every system looks stable right before it isn't, then this channel is already for you. Take a second, subscribe quietly, deliberately, like someone who has seen cycles come and go, and tell us in the comments, from where in the world are you watching this unfold? They did not hear the warning at first. Most people never do. The bond market is designed to be boring. It is meant to sit in the background, calm and predictable, like plumbing hidden behind walls. When it works, nobody talks about it. When it breaks, everything else follows. In early 2026, the signals were subtle. Long-term government bond yields moved higher, not in a single dramatic spike, but in uneasy steps. Prices fell. Volatility crept in. Auctions became harder to digest. Commentators called it noise. Policymakers called it manageable. Investors told themselves it was temporary. But beneath the surface, something different was happening. For decades, government bonds had been treated as unquestionable. They were the foundation of pensions, bank balance sheets, insurance reserves, and global collateral systems. The assumption was simple. Governments always pay, currencies always hold. Time smooths out all risks. That assumption was no longer holding quietly. When long-term yields rise sharply, it is not just about interest rates. It is about trust. It is about lenders demanding more compensation to hold promises that feel less certain. In the bond market, price is confidence made visible. By January, confidence was thinning. Debt levels were historically high. Governments had grown used to borrowing cheaply. Low rates had allowed deficits to expand without immediate pain. But as yields rose, the math changed. Interest costs grew faster than revenues. What had once been a background expense became a political and financial burden. This is where the danger begins. When debt becomes expensive to service, governments face a narrow set of choices. They can cut spending, raise taxes, default, or dilute the currency. History shows which option is usually chosen. Austerity is unpopular. Default is destabilizing. Currency dilution is quiet, technical, and often disguised as support. Markets understand this pattern well. They have seen it across decades and continents. When debt pressure rises and policy flexibility shrinks, money creation tends to follow, not immediately, not openly, but steadily enough to matter. This is why the bond market matters more than headlines. Stocks can fall and recover. Real estate can slow and reprice. But when bonds lose stability, the entire financial structure feels it. Banks depend on bonds as collateral. Pension funds rely on predictable bond income. Governments rely on constant refinancing. A bond market under stress is not a sector problem. It is a system problem. As yields climbed, another quiet change took place. Currency markets became restless. Capital moved defensively. Central banks spoke more often about stability and orderly markets. Language matters. When officials shift from talking about growth to talking about stability, it signals concern. Stability is not discussed when things are calm. It is discussed when something is at risk of breaking. At the same time, hard assets began to respond. Gold moved first. It climbed with purpose. Investors treated it not as a trade, but as insurance. Silver followed with more speed and less patience. Pullbacks shortened. Momentum compressed time. This behavior was not random. Silver sits between worlds. It is both a monetary metal and an industrial one. It reflects fear and demand at the same time. When silver starts gaining ground against gold, it signals a shift in risk perception. The market is no longer just hedging, it is positioning. What made this moment different was context. This was not a low-debt world. It was not a disciplined fiscal environment. It was a system already stretched, where confidence mattered more than forecasts. In such conditions, markets reprice quickly once trust weakens. Repricing does not mean slow adjustment. It means old reference points lose relevance. Prices stop behaving like prices and start behaving like warnings. For serious decision makers, this distinction is critical. A normal rally rewards optimism. A repricing punishes delay. Most people look at prices and ask whether something is expensive. More experienced observers ask whether the unit of measurement is changing. When currencies are diluted to preserve debt markets, asset prices rise not because assets improve, but because money weakens. This is the risk few prepare for. The bond market does not announce panic with sirens. It signals through tension, through rising costs that refuse to settle, through confidence that quietly erodes. By the time the public notices, the adjustment is already underway. This part of the story is not about prediction. It is about recognition. When bonds lose their quiet role and metals begin to move as if escaping gravity, the system is speaking. The only unanswered question is whether the response will preserve confidence or sacrifice currency to protect the structure. They believed they still had control. That belief is common in every system just before pressure becomes visible. Policymakers spoke with confidence. Analysts repeated familiar phrases. Markets were told that tools existed, experience existed, and that nothing truly new was happening. But history shows that systems rarely fail because leaders lack tools. They fail because the tools no longer work the way they once did. For years, governments had relied on the same playbook. When growth slowed, rates were cut. When markets panicked, liquidity was added. When debt grew, refinancing was delayed with lower borrowing costs. Each solution worked long enough to become habit. The problem was not the strategy itself. The problem was scale. Debt had grown faster than income. Obligations had expanded faster than productivity. The margin for error had narrowed quietly year after year. By the time yields began to rise meaningfully, the system was already stretched. At that point, policy choices became constrained. Raising interest rates too much risked collapsing bond prices and destabilizing banks and pensions. Cutting rates too quickly risked reigniting inflation and weakening currencies. Doing nothing risked losing credibility altogether. This is the trap of late-stage debt systems. Every option carries cost. Every delay compounds pressure. And every public statement is watched not for reassurance, but for weakness. Markets are not emotional, but participants are. When investors sense hesitation, they respond defensively. Capital does not wait for clarity. It moves when uncertainty grows. That movement began to show in subtle ways. Bond volatility increased even on days without major news. Currency pairs moved sharply on routine statements. Equity markets reacted less to earnings and more to rate expectations. The system was becoming policy dependent. Policy dependence is fragile. When markets require constant reassurance, the absence of reassurance becomes a signal. Silence becomes risk. Neutral language becomes fear. This is where the illusion of control starts to crack. Central banks can influence short-term rates, but long-term confidence is harder to manage. Long-term bonds represent belief in future stability. When buyers demand higher yields, they are asking for protection against uncertainty. They are pricing risk that cannot be talked away. As this dynamic unfolded, metals behaved differently than traditional assets. They did not wait for confirmation. They moved ahead of official responses. Gold reflected caution. Silver reflected urgency. Silver's behavior was especially telling. Unlike gold, silver is thin. It does not absorb demand smoothly. When interest increases, price reacts quickly. This makes silver uncomfortable for policymakers because it moves before explanations are ready. It signals stress before narratives catch up. While officials spoke about balance and patience, silver prices moved as if balance was already lost. Pullbacks were shallow, recoveries were fast. The market acted as though it no longer trusted time to solve the problem. This was not speculation alone. Industrial demand continued in the background. Our electrification, technology, and infrastructure absorbed supply steadily. At the same time, investment demand began to return not as excitement, but as caution. This combination is dangerous for stability. When both industry and investors want the same asset, flexibility disappears. Price becomes the only rationing mechanism. And price, once unleashed, does not move politely. Policymakers understood this risk, even if they did not say it openly. That is why language became careful. That is why discussions shifted toward orderly markets and liquidity support. These phrases are not used in strong systems. They are used when confidence requires maintenance. But maintenance has limits. Liquidity can calm panic temporarily, but it does not erase debt. Support facilities can slow declines, but they cannot force trust. Over time, repeated intervention teaches markets one lesson. Stability depends on printing. Once that lesson is learned, behavior changes. Investors shorten their horizons. They move toward assets with no counterparty risk. They question promises, backed only by future policy decisions. This is when metals begin to separate from financial assets. They are not reacting to growth forecasts. They are reacting to credibility math. They respond to the recognition that currency units may be used as tools, not measures. For business leaders and entrepreneurs, this distinction is critical. A world where prices rise because of productivity is different from a world where prices rise because money is diluted. In the first, planning rewards efficiency. In the second, planning rewards protection. The illusion of control fades when policy choices are reduced to managing damage instead of shaping outcomes. At that stage, markets do not ask what leaders want to do, they ask what leaders must do. And when that question dominates, repricing accelerates. Part 2 of this story is about constraint, about the moment when confidence is no longer restored by words and action itself becomes the risk. The system had not broken yet. But it had reached the point where every move mattered, and every delay carried a cost. That tension sets up the next phase, the one where reactions replace intentions, and where silver's role becomes impossible to ignore. They assumed scarcity meant running out. That assumption has misled decision makers more times than almost any other. In modern systems, shortages rarely begin with empty shelves. They begin with bottlenecks, delays, and rising friction that quietly change behavior. Silver was not disappearing from the planet. Mines were still operating. Refineries were still producing. Inventories still existed on paper. Yet the market began to act as if access, not existence, was the problem. This distinction matters. Functional scarcity occurs when an asset exists, but cannot move freely to where it is needed when it is needed, at a price participants accept. It is not a geological issue. It is a logistical and financial one. In early 2026, silver showed clear signs of this shift. Industrial users did not panic publicly. They rarely do. Instead, they adjusted quietly. Procurement timelines shortened. Inventories were padded. Contracts were secured earlier than usual. These are defensive behaviors, not reactions to headlines. At the same time, investors began asking different questions. They were no longer focused on whether silver was cheap or expensive. They were focused on whether it would be available later under the same terms. That change alone alters market structure. When participants care more about access than price, volatility follows. Silver's supply chain is more rigid than most people realize. A large portion of production comes as a byproduct of other metals. That means supply does not respond directly to silver prices. Even sharp price increases cannot quickly bring new output online. This delay is not theoretical. It is structural. Mining projects take years. Refining capacity is finite. Fabrication competes with industrial demand. When stress builds across all these layers, flexibility disappears. Paper markets can hide this tension for a time. Contracts can be rolled. Settlements can be delayed. Inventory classifications can change without metal moving. On screens, everything looks normal. In practice, stress accumulates. This is where silver becomes uncomfortable. Because it is used, not hoarded exclusively, its availability matters in real time. Unlike gold, which can sit in vaults untouched, silver flows through systems. When flow slows, price reacts faster. As this dynamic unfolded, silver began to behave less like a commodity and more like a signal. Price movements became sharper around delivery periods. Short-term dislocations appeared. Premiums in physical markets diverged from futures pricing. None of these alone caused alarm. Together, they painted a pattern. The pattern was simple. Flexibility was shrinking. For entrepreneurs and business leaders, this kind of shift has broader meaning. It signals that systems built for efficiency are encountering stress. Just-in-time models struggle when inputs become uncertain. Hedging becomes less effective when volatility rises suddenly. Uncertainty forces conservative behavior. Manufacturers secure supply earlier. Investors reduce exposure to promises. Institutions rotate toward assets that cannot be diluted or delayed. This is not panic. It is adaptation. What made silver especially important in this phase was its size. The silver market is small relative to global capital flows. When even a modest shift in allocation occurs, the effect is outsized. This is why silver does not trend gently during stress. It lurches. That lurching behavior is often misunderstood. Critics call it speculative. In reality, it reflects a mismatch between demand speed and supply rigidity. When confidence erodes, timing matters more than valuation models. Functional scarcity changes psychology. Participants stop asking, is this fairly priced? And start asking, will I regret not securing this now? That question drives decisions under uncertainty. Meanwhile, policymakers watch a different set of indicators. They see price volatility as a threat to stability. They worry about signaling effects. A rapidly rising silver price draws attention to currency dynamics. It invites uncomfortable comparisons. This is why precious metals often become sensitive topics during stress. They reflect not just economic conditions, but confidence conditions. By this stage, the system had entered a feedback loop. Bond stress encouraged currency dilution. Currency dilution encouraged hard asset demand. Hard asset demand exposed supply rigidity. Supply rigidity accelerated price movement. Price movement fed back into confidence concerns. Each step reinforced the next. None of this required a crisis headline. It required only enough uncertainty to change behavior at the margins. Markets move at the margins first. Systems break at the margins last. Part 3 of this story is about realization. Not that silver was rare in absolute terms, but that it was becoming harder to rely on under familiar rules. That shift does not reverse easily. Once participants adapt to scarcity, even temporarily, they remember the lesson. And when memory changes behavior, price rarely returns to its old role. The system had not reached its breaking point yet, but the conditions for rapid repricing were no longer theoretical. They were functional, measurable, and increasingly difficult to ignore. They expected the move to be smooth. That expectation has ended more cycles than bad timing ever has. In every major repricing, there is a moment where confidence is tested, not by decline, but by violence. Prices do not drift lower. They snap. They do not warn. They punish certainty. Silver has a history of doing this better than almost any other asset. As prices accelerate, participation increases, traders add leverage, late buyers enter with urgency, commentators grow louder, certainty spreads. That is precisely when the system applies stress. The midpoint shock is not a reversal of the thesis, it is a test of it. In this phase, the market creates a drop large enough to feel like failure, but fast enough to deny preparation. Losses appear suddenly, gains evaporate, narratives flip in hours. This behavior is not accidental. Thin markets under stress expose positioning. When leverage becomes crowded, price does not need a reason to fall. It only needs sellers who cannot hold. Margin rules change, liquidity thins. Forced selling does the rest. Silver, because of its volatility, magnifies this effect. A decline of 10 or 15% can occur in a single session. For the unprepared, it feels catastrophic. For the disciplined, it is diagnostic. It reveals who owns the asset by choice and who owns it by necessity. This distinction defines outcomes. Those who entered with borrowed time exit first. Those who entered with borrowed money exit faster. Their selling provides liquidity for stronger hands. Price stabilizes not because fear disappears, but because ownership changes. Midpoint shocks serve a purpose. They reset expectations. They destroy the illusion of easy gains. They remind participants that structural moves are not designed to be comfortable. Comfort attracts crowds. Crowds destabilize thin systems. For business leaders and serious investors, this phase carries a lesson that extends beyond metals. Every system under stress tests its participants. Companies test balance sheets, markets test liquidity, assets test conviction. Those without margin for error are removed. This is not moral judgment. It is mechanical. The danger lies in misinterpretation. Many observers mistake the midpoint shock for the end. They assume the thesis failed because price moved against them. They sell not because fundamentals changed, but because uncertainty became painful. This behavior reinforces the cycle. As weaker participants exit, the remaining holders are more resilient. Volatility compresses again, dips shorten, recovery accelerates. The move resumes with less resistance. Silver's history is filled with these episodes, sharp advances followed by brutal pullbacks, followed by even sharper advances. Each time, participation narrows. Each time, the market becomes more unstable, not less. Policymakers observe this phase with concern. Rapid price swings challenge stability narratives. They invite questions about currency value. They draw attention to systemic stress. As a result, intervention becomes more likely, not less. This creates a paradox. Intervention can stabilize markets temporarily, but it also confirms the very risks participants are hedging against. Support calms prices, but it reinforces the belief that the system requires constant maintenance. That belief favors assets outside the system. By the time the midpoint shock resolves, behavior has shifted. Investors become more selective. Leverage declines. Ownership consolidates. Price becomes more sensitive to demand imbalances. At this stage, silver often begins to outperform expectations. Not because excitement returns, but because resistance weakens. Fewer sellers remain. Each incremental buyer moves price more than before. This is when the public starts paying attention. Unfortunately, public attention usually arrives late. It focuses on price, not process. It chases confirmation instead of understanding structure. For those who endured the midpoint shock, this phase feels quiet. For those who exited, it feels unfair. Markets do not reward fairness, they reward preparation. Part 4 of this story is about selection. The system does not break everyone at once, it breaks those least prepared first. The midpoint shock is the filter. It separates exposure from ownership, hope from planning. What follows is not guaranteed, but the conditions for acceleration improve. Because once weak conviction is gone, and once forced selling is exhausted, the path ahead narrows. And in narrow markets, price does not ask permission before it moves. They notice it late. That is not an insult. It is a pattern. Most structural shifts only become visible to the public after the hardest part is already over. By the time headlines appear, the adjustment has already punished hesitation and rewarded preparation. This phase begins quietly, but it does not stay that way. After the midpoint shock clears out weak conviction, the market enters a different state. Volatility does not disappear, but its character changes. Dips are bought faster. Sellers hesitate. Liquidity becomes uneven. Price begins to move in bursts instead of trends. This is when repricing turns visible. For silver, this stage is defined less by technical signals and more by behavior. Buyers no longer wait for ideal entries. They respond to availability. Dealers adjust terms. Contract conditions tighten. Delivery timelines matter more than quoted prices. These are not speculative signals. They are operational ones. At the same time, gold continues its steady roll. It absorbs institutional demand. Central banks accumulate quietly. Long-term allocators treat it as a reserve, not a trade. Gold's movement validates the broader narrative without drawing panic. Silver reacts differently. Because of its smaller market size and mixed use, silver accelerates when attention increases. Each new buyer matters more. Each delay in supply has greater impact. Price becomes less anchored to recent history. This is when old reference points fail. Targets that once seemed extreme begin to appear less theoretical. Analysts revise assumptions, models are updated, explanations become backward-looking. The public begins asking whether something fundamental has changed. It has. The unit of measurement is under question. When currencies are diluted to maintain debt stability, asset prices rise not as a sign of prosperity, but as a signal of adjustment. The public often interprets this as a boom. In reality, it is a recalibration of value. This distinction is uncomfortable. It forces decision makers to confront trade-offs. Holding cash becomes a strategy with risk. Fixed income loses its certainty. Planning horizons shorten. Preservation competes with growth. For entrepreneurs and business leaders, this phase is decisive. Costs become harder to predict. Financing terms shift quickly. Hedging strategies must be revisited. Assets that once served as safe buffers behave differently. Those who understand the nature of repricing adapt faster. They focus on resilience, not optimism. They reduce dependence on assumptions that require stability to hold. Public participation changes the narrative. As silver prices move into widely discussed territory, skepticism fades. The question shifts from, is this real, to, is it too late? This is the most dangerous question in markets because it invites emotional decisions. Late entrants tend to chase confirmation. They respond to headlines, not structure. Their presence adds fuel, but also instability. This is when policy pressure intensifies. Officials face rising scrutiny. Asset price moves draw political attention. Rising metals prices are framed as inflation signals. Calls for intervention grow louder, yet intervention becomes harder. Supporting bond markets without weakening currencies requires precision that late-stage systems rarely achieve. Each action stabilizes one area while stressing another. Trade-offs become visible. Markets sense this tension. Silver responds not to speeches, but to outcomes. Each policy move that favors debt over discipline reinforces the repricing logic. Each delay confirms uncertainty. By this point, the move is no longer niche. It affects expectations, it influences behavior, it reshapes planning. Businesses adjust strategies, households reconsider savings, institutions revisit allocation frameworks. Repricing has become social knowledge. That does not mean it is complete. History shows that once repricing becomes widely acknowledged, the final phase often arrives faster than expected. The last stage is rarely calm. It is defined by urgency, not analysis. Part 5 of this story is about visibility. When structural change becomes obvious, options narrow. Those who prepared earlier focus on managing exposure. Those who arrive late focus on catching up. Markets do not pause to accommodate either group. The system is now operating in a different regime. The old anchors no longer hold. And the final outcome depends less on intention and more on how the next shock is absorbed. That is the point where consequences stop being abstract and begin to define a new normal. They always ask the same question at the end. What happens after? It is the right question, but it is often asked too late. By the time the final phase begins, choices narrow. Flexibility declines, outcomes depend less on intelligence and more on positioning that was decided earlier. The final phase is not defined by price alone, it is defined by behavior. When repricing reaches maturity, markets stop debating theory. They respond to consequences. Policy actions carry visible costs. Confidence is no longer assumed. It must be rebuilt, slowly and deliberately. This is the phase where systems reveal what they can tolerate. Governments respond first. They attempt to restore calm. Sometimes they succeed temporarily. Sometimes they shift rules. Capital controls, new regulations, emergency facilities, and redefined mandates appear. None of these are signs of strength. They are signs of adaptation. Adaptation is not failure, but it is not stability either. In this environment, currencies continue to lose purchasing power in real terms, even if headline inflation slows. The dilution does not need to be dramatic. It only needs to persist. Over time, persistence matters more than speed. Assets that depend on promises struggle. Fixed income instruments face uncertainty. Real returns are questioned. Long-term planning becomes difficult. Investors shorten horizons. Businesses prioritize liquidity and flexibility over expansion. Meanwhile, assets with no counterparty risk settle into a new role. Gold becomes a reference point again, not as a speculative instrument, but as a benchmark of trust. Silver, having gone through volatility and repricing, finds a different equilibrium. It may not move straight up, it may correct, it may consolidate, but it no longer behaves as it once did. The old price memory fades. This is what many misunderstand. The end of a repricing cycle does not mean a return to the past. It means a transition to a new baseline. Prices adjust, but relationships remain altered. For entrepreneurs and business leaders, this matters more than headline numbers. The environment after repricing rewards different skills. Risk management becomes more important than growth forecasts. Balance sheet strength matters more than projections. Access to inputs matters more than theoretical efficiency. Planning becomes defensive by necessity. Those who survive and thrive are not the most optimistic. They are the most adaptable. They understand that systems under stress do not revert easily. They evolve. This is also the phase where narratives are rewritten. What was once dismissed as alarmist becomes accepted as prudent. What was once called boring becomes foundational. The language around money, value, and security changes subtly, then permanently. New habits form. Households save differently. Institutions allocate differently. Governments legislate differently. None of this happens overnight, but it happens decisively enough to matter. The silver story, in this context, is not about a number. Whether prices peak at one level or another is secondary. The primary lesson is behavioral. When trust in paper systems weakens, tangible assets gain importance. When flexibility disappears, volatility rises. When volatility rises, discipline becomes the edge. This cycle does not repeat exactly, but its structure is familiar. Debt grows, confidence stretches, policy intervenes, currency dilutes, assets reprice, behavior adapts, a new equilibrium forms. Those who understand this sequence do not panic, they prepare. The final phase is not dramatic for everyone. For some, it feels like relief. For others, it feels like loss. The difference lies in when decisions were made. Late action is always more expensive. By the time repricing is obvious, the opportunity has shifted. It is no longer about positioning for upside. It is about preserving optionality, about avoiding fragility, about staying solvent and flexible in a changed system. That is the quiet ending most documentaries miss. There is no single collapse, no clean resolution, just a gradual acceptance that the old assumptions no longer apply. For those watching closely, the warning was always there. In bond yields that refused to settle, in currencies that required constant support, in metals that moved ahead of explanations. The system did not fail suddenly, it adjusted under pressure, and the future belongs not to those who predicted the highest price, but to those who understood the cost of delay and planned accordingly.